I would say the first thing that you have to do is think about the purpose of money, and that you're saving and immunizing yourself against the purpose of money and what is most valuable of that. Almost if you were to think, can I buy my apartment or secure my future? If I could pre-buy my kids' education, if I could pre-buy those types of things so that I can immunize myself, I can hedge myself, that I'm going to be good and I'm going to be stable. I know when I started working out, when I was in the position you're describing, I said to myself, how many weeks, months, or years could I live without our money coming in? If I should be dropped and I lose my job or something, how do I establish that security to basically immunize those types of things? I think that starting out with thinking about the purpose of the money and how you immunize yourself against those things is very, very important. Then when you go to higher levels, then you decide how you're going to take risks relative to that. It would be first immunize yourself against those things, then secondly, think about the returns in real returns, and most importantly, how you diversify well. The power of diversification, the holy grail of investing, when I discovered it, it meant everything to me, was can I find optimally 15 good uncorrelated return streams? Because the power of diversification, good diversification means that you can reduce your risks by 80% without reducing your expected returns. And that means you improve your risk-return ratio by a factor of 5. And if you can understand how to diversify well, immunize your liabilities, I think that's the approach that I would take. It means the uncertainties are going to be great. Think about the implications, let's say, AI is going to have on companies, who the winners and the losers are. We have a lot more uncertainty about who the winners and losers are. If I take any one of these factors, what it does is it creates much more uncertainties. And so it makes diversification. And then you think about diversification of asset classes, diversification of countries where you're diversified in. All of that diversification is going to matter, I think, more, not less.
Things seem to be increasingly correlated, so it's harder to find real diversification. Can you mention some assets that are really uncorrelated these days?
First of all, correlation is an outcome of the determinants of the pricing. Correlation doesn't intrinsically exist. And if you look at the pricing of asset classes, it makes sense. For example, stocks will go up when growth is faster than discounted, and it'll go down if it's less. Bonds are the opposite sort of way, generally speaking. The way I think of diversification is that there are 4 main quadrants in that. That means inflation rises or declines, or growth rises and declines. And if by looking at those and putting those into those 4 quadrants, I'm trying to then create that's the template. How diversification changes through time is a function of those drivers. And so when I create the diversification, those are the drivers I look at. Of course, the tightness of money and the looseness of money raises or lowers all boats, or all investments. If you look at the structure of the determination of the correlations, so you have that structural diversification, not just looking at what the recent correlations are, because correlations change over time. But the determinants of those correlations don't change.